Uncertainty at the Fed impact bank stocks. They got crushed during Friday's sell-off and are down slightly today. Our next guest says buy the dips as their foundations are strong. Joining us now, Barry Knapp, Ironsides Macroeconomics Managing Partner. Barry, good to see you.
Hi, Melissa.
If what Steve says is correct in terms of the accelerated timeline, is that doesn't sound like a good thing necessarily for banks.
I actually think it'll be fine for banks. So I think Steve's probably onto something. I had been operating under the assumption that Friday's payroll report will be quite strong. The inflation numbers for November, released mid-December, would be strong, and we probably would have gotten that acceleration of the taper in December. Okay, so you move it to January, and then think about what's likely to start to happen to the fixed income market again. And this isn't the core of my thesis for bank stocks, but we'll start here because it does clearly impact how the stocks trade and investor psychology around them. But you'll start to get the same sort of push that we were getting up until, the Omicron variant emerged, where you'll start to pull rate hikes forward. The Fed will be even further behind the curve. I strongly agree with Steve's final point is this is more of an inflationary shock than a shock that's likely to slow growth. So when we've already seen lockdowns in Asia, so that's going to put further pressure on supply chains. And it also increases the probability of goods prices being permanent, or goods price inflation being permanently stronger. So you'll start to push rate hikes, at least in the back end of them, up further. You'll also see those inflation break-evens start to move out quite a bit. It'll be another one of these Fed is behind the curve kind of trades. And that, will probably help bank psychology. But what's more important for me with what's going on with banks right now is you're seeing a real pickup in loan growth. And they're starting to cut securities holdings, or at least slow their accumulation of securities holdings. This is really good for return on equity, which is already at its highest level since pre-global financial crisis. So the underlying fundamental story is getting better. And this really is only going to delay the rates Fed behind the curve. And the further the Fed gets behind the curve, the more they're going to have to push that front end up. And that front end is really what's going to drive bank profitability.